Hey guys, welcome back to Investing in Stocks for the Long Term. This is Tom. I am coming at you with a new opportunity, Pitney Bowes. Now, you may be wondering what is up with this? Some mail company, metered mail company, 100-year-old metered mail company? Well, I learned from Justin over at Domo Capital Management, who initially turned me on to Gamestop, which is not something probably that you want to hold long term, at least at its peak levels. Now, I do believe in the turnaround story. We'll have to monitor it, see what the plan is with Ryan Cohen. But I think right now your risk reward is probably better in something else like that is farther along down the path. And I'm going to explain that with Pitney Bowes. Now, Pitney Bowes, like I say, they used to be primarily just a mail business, but they've transitioned into shipping solutions, mailing solutions, kind of like a stamps.com type of thing, and returns, kind of facilitating all the increased e-commerce that we've been seeing with since the virus. So let me show you first a investor letter. We'll go through that and then glance at the investor presentation, and I'll let you get out of here because this is kind of a boring stock. I don't think it's going to be ever become a meme stock, uh, you know, like we saw with GameStop. So Pitney Bowes embodies several characteristics that seem to show up in many of our investments: overlooked, unloved, misunderstood, sometimes all three. Together, these forces have pushed Pitney Bowes shares lower. Of course, it's not too difficult to understand how this came to be the case. The company's glory days, back when it was lauded in Jim Collins' Good to Great for leasing mail meters and offering pre-sort services, had long since passed. Though these businesses continue to generate nice cash flows, I like that. Mailing revenues have steadily declined for years. I think it's been about 2% a year. Consolidated financials, I don't know where the floor is. I always like to think about the floor, like what's the floor for physical games, what's the floor for books, but that's something I don't have the answer to. Consolidated financials are not pretty, okay, with earnings declining constantly for much of the past decade. All this for a 100-year-old company that not so affectionately these days goes by the moniker the mail company. But buried within these consolidated financials that paint the picture of a shrinking company, Pitney Bowes. Now, this is where you don't need to click away. This is where you need to like and subscribe and all that stuff and leave a comment about what your favorite e-commerce company is. Pitney Bowes has been building a very promising e-commerce business. It has been a long time coming, but after first getting into the business 8 years ago with their acquisition of Nugistics, the shipping business appears poised to thrive. Other factors suggest the company's fortunes may be turning as well. In recent years, the company has gotten serious about turning things around. Management has refocused the company around mailing, shipping, and financing. They've sold off a number of non-core segments, in addition to refocusing the company and simplifying the narrative for prospective shareholders. These moves have also enabled the company to improve its balance sheet, with the majority of debt now supporting the company's financing business. So now the mail company is shipping, financing, and mailing with emphasis on shipping. Now, in terms of where they are with their shipping revenue, let me just glance at the investor presentation. We're about to see where they show what they have been doing, and they go down here to the shipping revenues. This is moving a little slowly. Simplify and focus business model. Okay, here we go. Coming up to the shipping. Okay. Percent of revenue from shipping products and capabilities: 24% in 2017, 39% in 2019, 50% in 2020. That's the type of growth numbers that gets me excited. And so now let's go back to the letter. The global e-commerce business is promising. It serves as a capacity-constrained segment of the economy that enjoys natural tailwinds from a package delivery market that has been growing steadily at mid-teens annual rate for years. Its principal focus is on domestic parcel delivery. Now, here's where it kind of explains what they do for the part that we're most interested in. Here it focuses on the middle mile, retrieving packages from small and medium sized businesses, delivering them to the post, post office, who handles final mile delivery. It also offers cross border solutions and shipping solutions with a primary emphasis on offering transparent and easy to understand pricing models. So, like if you're a small business and you want to know, okay, does FedEx offer a better rate? Does UPS offer a better rate? You use one of their solutions and it's a sort of a seamless thing. You don't have to spend a lot of time. And I know people that have that type of business, they like everything smooth. And this is the type of software that I believe would help them. More research is needed in that to see really how good it is. But and moving on, before the pandemic, there were early signs of success. The global e-commerce segment had grown to well over a billion in sales, or nearly 40% of the whole company. But like a lot of promising young business, it was subscale and unprofitable. In 2019, the segment lost 70 million, detracting 30 cents from the company's 68 cents of earnings that year, but the pandemic looks to accelerate this segment's push to scale. In Q4 2020, domestic parcels grew at a promising 76% year over year by growing its top 1,000 retailer client count from 12 to 63 in 2020. They just passed DHL, who I don't actually know really anything about, need to learn about them, and their top 32 1,000 e-retailer count to move to number 4 on the list. Volumes are now near levels the company had previously suggested operations could become profitable, but due to a deluge of one-time and unabsorbed cost, the segment is still not profitable. Some costs are COVID-related, some come from unabsorbed warehouse facilities, others reflect lower operational efficiency than one would expect from a scaled operation. I know they're trying to work I read in the conference call, they're trying to go from temporary employees to more full-time employees, and I think some of their trucks were rented rather than owned because they weren't ready for the surge. But the fact that the profitability has been pushed out a bit, the company has clearly done the right thing for itself by doing the right thing for its customers. Accordingly, it's likely to keep these customers, and there's little reason to suggest profitability cannot improve over time as previously envisioned. A few months ago, when we began building our position, shares looked attractive with downside reasonably well protected due to a 3% dividend yield, 20% free cash flow yield to equity. Upside looked attractive as well. Previously, I'd written the investment with a view that the company could produce $1 of earnings or better in the coming years under the assumption that SynTech segment revenues would continue to shrink from declining mail volumes at a mid-single-digit level annually, while the global e-commerce could approach the low end of their 8 to 12% operating margin target. Like all our favorite investments, downside looked reasonably well protected. Now, this once again kind of reminds you of GameStop. Yeah, they've got a little bit of debt. They have 2.6 billion debt. They paid down 175 million of it. So as far as I know, the bonds are basically trading at par. I looked at them the other day. I need to check again to make sure that I didn't make a mistake on that. I mean, that's an important thing. But I think the bonds, the debt, this is like GameStop. It's not something that's about to go bankrupt. They've got time. They're actually well on their way. GameStop has not really transitioned to the percent of their sales that are coming from e-commerce is still quite small. The percent of sales coming from e-commerce here is 50% of the business roughly. So, and then they talk about how the shares got caught up in the short covering rally because this did have about 30% short interest, but we know a lot of the high short interest stocks were targeted. Perhaps one of the funds that was short this was also short GameStop, so they had to rebalance the portfolio. These guys took some profit. Recent evidence suggests two critical assumptions referenced might be too conservative. While one quarter does not a trend to make, perhaps the terminal decline of the SynTech business may have been exaggerated as success in cross-selling digital initiatives produced better than anticipated results. As for global e-commerce, now more than half of company sales, other industry participants seem eager to push pricing for services higher. And that's what Justin talked about. He talked about prices do go higher in logistics. A factor that, of course, would be positive profitability. Accordingly, after lower prices returned, we repurchased shares at recent levels, possess same characteristics of low downside, promising upside. Consider at the time of our initial investment. I think they've got an analyst day coming up later in March, so it'll be interesting to see. Justin talks about this could be an 18-month hold. I don't know if that fits the definition of investing in stocks for the long term, but it's certainly closer to the net strategy, closer to the value strategy that has been so tricky for many of us. I've also been reading Chris Meyer's 100 Baggers lately, learning about the companies that have gone up 100 times. So hopefully I'll be doing a review on that, maybe talking about some more market wizards guys. Um, just quickly, if you guys are still with me, we'll just glance through the investor presentation a little bit more here to see kind of what they do. We can see the expenses have come down too, as the revenue's gone up. Let's see some diversity here on their who we are, and I know they actually do have a higher percentage of women minorities in their sales force than and I believe even higher up than a lot of companies do. So that is a plus. So they're shipping, they're mailing, they're financing. I don't really know about this Commerce Cloud thing, but I think most of their business is domestic. I think it's about 75%. Um, their earnings are less. Are they lost $3 million less than last year quarter, despite adding 3 warehouses and doubling the employees. Um, the mail meter business is flat. Um, Slightly lower, but the mail volume declined 3%. If you don't have the numbers on the mail meter business, you need to check that. 85% of their clients use multiple shippers, so that's helpful for them. Like I said, allows them to use one service to do all this and save money. Now, the concerns with the stock, the guidance was not, it's mid to low single digits. I think they just have a conservative management. This story's taken a long time to play out, and I think they're under promise over deliver because they haven't been able to deliver for a while. So your downside is limited, but it's a little bit of a show me story in terms of can they get the cost down, can they get the profitability up. I didn't know that type of stuff mattered anymore after what we see in the rest of the market, all these bubbles and EVs and blink charging and all the rest of it. But for a stock like this, I think the earnings do matter for these type of investors. Justin comments, well, you can see there, I meant to say that cost-effective last mile delivery, faster processing, fulfillment, cross-border and shipping solutions. I mean, this is the type of stock you want to be in. What other cheap stocks like this are there? I don't. If you have one, let me know down in the comments below. Delivery guarantee offering, guaranteed quotes. Here's a chart that shows how everything works. And for integrated tracking, they talk about how they are good at returns, how they have better customer satisfaction in terms of there's the retail e-commerce sales as a percent of total retail by quarter, which we like to see. They claim to have a differentiated experience in terms of confidence during each stage of the journey compared to FedEx, UPS, and the others. Now let me quickly go to one of Justin's comments on his Seeking Alpha article. Global e-commerce has inflected and legacy business has stabilized. Guidance appears due to messaging by the Fed. So some people think about the Fed a lot, as you may know. We believe management is being too conservative. In addition, stimulus all but guaranteed. I suspect guidance is ramped up later in the year. Combination of lower cost per parcel on a material increase in the number of parcels shipped will have a multiplier effect. Combination of lower costs per parcel on material increase in the number of parcels shipped have a multiplier effect. Okay, I could see that. The largest costs that we are currently a headwind will become tailwinds I guess as you hit a tipping point, I guess is what he's saying. Um, no cost for parcel material increase in number of parcels. Yeah, that makes sense. Most importantly, even though costs will continue to go down, prices will continue to go higher. They always do in logistics. I worked in strategic pricing for FedEx for 5 years. They don't have a lot of visibility and wanted to be conservative. Nothing wrong with that. Um, so they also help you like see the duties and taxes, and they help you deal with importation documents. So that's the type of thing that people who have online businesses, they don't want to deal with all that type of stuff. They want all that streamlined and seamless. Um, so, you know, I think Pitney Bowes is one of the best stocks right now in the market. They've got a good amount of insider ownership. I think it's about 5%. Let's glance at the FinViz stats here. Short interest, I believe, has come down to about 4%, which I mean, I consider that bullish. I'm not trying to play the short squeeze. Roaring Kitty always said the short squeeze stuff is marginal analysis. It's a sideshow. Cheers, everybody. Cheers. Um, no, shout out to Roaring Kitty, but I'd actually like his take on this thing. But we can see, the price action is looking fine. There's the short covering, bounced off the 50-day, stabilized. Sold off a little bit with the market, to be expected, but you can see got some price to sales of 0.4, short interest 4%, insider owned, insider transactions. Let's see, director bought, well, he bought a lot lower in September. So not too much insider buying, but a lot of funds, respected funds are in this thing. If you look at the long-term chart, you can see that it used to be much higher. So, reminds me a little bit of GameStop. The shares outstanding, 163 million. So, guys, Pitney Bowes. I might have to start like doing 3-hour streams on Pitney Bowes 3 nights a week, like Roaring Kitty did on GameStop. Get everybody's comments. No, I don't think so. But anyway, until next time, um, where we will talk some more.